Master Trader Live. Simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Good afternoon, everybody. Welcome to Master Trader Live. It's Wednesday. Dan and I are here on schedule again with another great MT Live. Today, we're going to be talking about credit spreads with 0 days to expiration. They're the best. Right? Some work to be done to find the setup, of course, which we're going to show you. And, less than 24 hours risk, no gap risk, which is fantastic because, hey, look, every strategy has its pluses and minuses. And this one, minuses, you better know how to manage it. And Dan's an expert and he's going to explain it to you. So he's the best at it. And we're going to explain the nuances to it, the basics, some advanced stuff. But for a strategy, for credit spreads that have less than 24 hours of risk, this is one of the best. And, you can do it in different ways. SPX is one that one cuts, it's one of a little bit of a roller coaster ride at times because of the leverage. There's SPY and of course, stocks that are expiring on expiration day and gaps and all that. So it's a great strategy for using options and spreads. And so let's get to it. Daniel.
Awesome. Welcome, everybody. This is an amazing strategy, folks. If I told you what I'm going to show you in the next hour here, if I told that some of the things that we're going to teach you in a marketing little email, you would say these guys are snake oil salesmen, but we're not, obviously. But Greg, I want to correct one thing you said. Well, not correct it, but more specificity, and that is you said less than 24 hours risk. And it's actually much better than that. It's 6.5 hours or less risk because we're putting these on as day trades and they expire in the same day. So let's jump right into it. This is a marvelous subject for all option traders, or even if you're not an option trader, because when you trade stocks, it's one-dimensional. It either goes up or down with your directional bias, whereas this you're going to see it's a whole different game. We're saying, hey, I think that's the high or low for the day, and I'm putting money in my pocket for taking that speculation. Just a little basic here if you're new to option trading. People buy options to give them the right to buy or sell the underlying. They buy it if they're bullish, they want to sell it if they're bearish. So they're speculating with this different instrument. It just gives them rights instead of having to go to the market and buy or short the stock. So today we're going to be selling that option. Well, it's a spread, but you'll see in a moment. So whenever you sell options, we're putting money in our account, in our brokerage account, immediately gets deposited. And then it's not free money, as some clowns might want you to think, but it's premium that is in our account for the obligation to buy or sell the underlying. But our approach is what gives us the confidence to assume that obligation. Let's continue. So we're going to get paid through time decay. I mean, the stock can just bobble around. It can even go against us, as you're going to see, and we still make money. I made a new slide that we'll get to later on that just talks about all of the misleading. It's all over the market, Greg, as you know. There's just BS out there. But we're gonna focus on a bunch of them regarding this pattern, because so many people will tell you, not this pattern, this strategy. So many people will tell you, run for the hills. That's crazy. They're gonna tell you all these misleading things that we're gonna dispel for you in the next 52 minutes. Here's our approach in this strategy. Everything we do at Master Trader starts with a compelling setup on multiple timeframes. And then Greg's amazing swing trading course goes through all of the components that make up our strategy to make us excellent chart readers. So that's our edge. Then we're going to sell these options, as I just said, and we're going to profit in hours, because the person who is buying these options, it's a time wasting asset, and it is like a melting ice cube into the close. So you're going to see in all these examples, we're going to sell them once we get our pattern, manage in between, and we're earning money while that asset that we sold, the option, is just headed towards zero. High volatility is preferred. We get high volatility on market sell-offs when the VIX gets really high, like in March, Greg, as you know. We absolutely cleaned up for our own accounts and our subscribers of using this method of selling options when the volatility was really high. Everything we do has an entry, a strategy, technical setup, and a stop loss. We don't put on any trade without a trade management. Spiders in the SPX, which is the big contract, they have multiple expirations. So most options, they obviously have monthly expiration, but that is only on the third Friday every month. A couple years ago, the exchanges came out with these weekly options, and I think that made my day, because now instead of having to wait for the third Friday of every Friday is like a candy day for us. And then what made that even better was, like I say here, the spiders in the XPX, they have Monday, Wednesday, Friday, and then quarterly Thursday, monthly Thursday. So we get these 0 DTE opportunities much more often than once a week. So here's what we're going to be doing. Start with a compelling pattern. Only movement of stocks, up, down, or sideways. We're going to show you the patterns and the time frames of how to do these. On bullish setups, we're going to sell a bull put credit spread. What is that? I'll show you, but it's going to be selling a put under support. Well, let's wait till the next slide. Stocks going down, bearish or reversals and sideways trends, we're going to sell bear call credit spreads. As long as it just bobbles around and doesn't go close above that short strike, we keep the money. So here's a better slide to show it. These are beautiful little stick figures. I'm not giving you the time frame. I'm not giving you the stock symbol. These apply to anything that has liquid options. So we are looking for these bullish pictures. And then we're going to go through our checklist, which I'll show you later. And the biggest one is they have to be liquid. We have to get a good premium. And we're going to sell a put under support. You can do it naked if your buying power is not an issue. What we like to do, just to make it less buying power, is then we buy a further out of the money put. This is what's called a bull put credit spread. The difference is the money that immediately hits your account. So one contract represents 100 shares. You sell one contract, that amount of money goes into your account. Let's jump right into some examples now. So that's the foundation. Now let's go into implementing this. The FANG stocks are always, provided they're liquid. Some are more liquid than others, obviously. And this actually, Amazon was on earnings day. Friday, they announced Thursday night. Friday, we're waiting to see what the stock does. This is, so Greg, I've been doing a lot of talking. Do you want to talk about this bearish daily, and then look where we ignored, where the green bar ignored, right where the arrow is. I mean, look how far away the strike is. Yeah, why don't you probably were in this with me that day.
That's a no-brainer.
So Greg and I like using the term no-brainer because when we both go through our trade checklist, if you will, we do it mentally, the risk to reward of the trade we're putting on is just, it's overwhelming. So tell them why this is overwhelming. Bear call credit spread, 0 DTE.
Well, the main reason is that the pattern that occurred historically never gets reversed completely. Historically, right? Anything's possible. We know that. But that kind of a pattern to negate it to that degree, I mean, it just doesn't happen. So when you're I can't say lucky because this isn't luck. It's a strategy and a method that we define and how to see and find these things and determine the probability. When you see them, it's a no-brainer because they just don't reverse that to that degree. So you put on the trade and you wait and see what happens. So I mean that's basically it. You have to be able to recognize the patterns, of course, the historical patterns, and that's what in part the course is about. So once you do that, you then go, which we'll get to, you go to the options platform there, and you see, is there premium? And so, we kind of call it factory work because who likes to do factory work? It's like, hey, go dig that ditch. And when you're done with that one, go dig another one. So that's not the fun part of it, but it's part of the process of saying, here's this pattern. And if I can go to the option table and there's premium there, that's the money. And that's, we go through the patterns, we go to the option table, we see if there's premium, risk to reward, blah, 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 put on the trade and wait 6 hours.
Well, and manage in between. We're trailing pivots intraday. So let me answer 2 questions here. Bob is saying, hey, I thought y'all were day trading. Why are you showing me a daily chart? Well, because unless you're just trading a scalp, like a 5 or 15-minute pattern, Bob, we always start at the daily for our overall bias. But yes, in this 0 DTE strategy, this was earnings. This is Amazon. Amazon's a tank, right? Who knows, as we say, this thing could have ripped right back up to $1,800 in an hour. But that's step 1. We have a bearish gap. Step 2 is drop down to a smaller time frame and see if we get a bearish entry. And that's why I'm marking right here, green bar ignored, suggested it was going higher, and it didn't. It then went sideways and broke down. So right where this arrow is, and I always love asking Greg this question, we then sold a 1720 call option up here. And then we took some of that money and bought a 1740. Again, you could have sold the 1720 naked, but it's so much buying power for $1,700 stock naked. We just go up 20, 10, 20, $30, whatever, because it really doesn't matter to us. The sole purpose is to make the buying power less. So Greg, once where this arrow is, in this, let's just call this 1 o'clock over lunch, breakdown. Sure. So we have 3 hours of risk, folks. Greg, what do you think the odds of this arrow then ripping up to 1720 in 3 hours?
Virtually none.
And now to answer the other question, Jason, if you all can put your drop down, all panelists and attendees, so other people can read your questions. And Jason saying, which I knew it was going to come out, it's going to be in my slide of myths of option trading. Greg, I hear it every single time, and that's because novices put that into their brain. Oh my God, you're risking. So our max risk, folks, by definition, this is a textbook answer. is the spread width. So that's $20 less premium received. So I'm taking $1.85 a share. Let's say I sold one contract, 185 bucks hits my account, and I am risking, per the textbook, $18.15. Everybody says, oh my God, that's a stupid strategy that I've ever heard. And I just have to say, well, that's because you don't understand. You don't understand. I'll just leave it at that. Our stop is over the day's high. Once it starts, so let's just eyeball this, the day's high, let's call it 1675. We're nowhere near the short strike. And as this premium is decaying, every 5 minutes, every hour, this $1.85 is melting like an ice cube into the close. So that's why we never suffer max loss, because we have stop losses. And I'm going to show you a slide later. A subscriber sent me this funny little cartoon of a man. He's like, oh my gosh, this is the craziest strategy ever. The stock went against me and I still made money. That is correct. The biggest problem of credit spreads, if you will, or even trading anything, is the gap risk. So yes, our max gain is 185 a share. If this thing gaps up to $1,800, we'd have a problem on our hands. But if you shorted the stock, you got a bigger problem on your hands. All right, let's continue. Just another example here, Tesla. Now Tesla, here's the daily. I need my bias on the daily, Bob, remember? So this is, and you know, everything Greg and I just love technical analysis. So this is what we call a bullish 180 reversal on the daily. And then it went sideways for 3 days. That's bullish consolidation. This is a 5-minute chart. These vertical arrows are pre-market. So it gapped up over intraday resistance. So it's on my focus list as a 0 DTE trade. Well, I'm looking at the fangs all the time. I have 6 big screens here. And so I noticed these bottoming tails after going under the pre-market bias. We call this a wide range igniting bar. And that's when we said, this is a perfect time to put on our put spread. So we sold the 775, 755, 88 cents a share. As it moved up, you can see here at 11 o'clock in the morning, so less, 90 minutes later, we're already at 80% of max profit. That's a beautiful setup. And my stop is under this this prior support over here.
Dan, just to add a little bit more to why we picked these, is that those bottoming tails right there, they told us what the big money was doing. And it broke down through support and it sprung right back up 2 times.
Okay.
They had a double chance to get in on the cheap, and they proved to us twice that they came for the stock aggressively. So these patterns,
with a bullish daily.
Right. So everything's a combination. And I lately, Dan, I'm repeating this in the chat room, in the green room, almost on a daily basis, because everybody asks questions about a specific concept, because that's what sticks in their mind as they're beginning. Because when you're new to anything, you pick on certain things and that you remember in the moment. So MTS strategy is built on multiple concepts. A concept isn't a strategy. So as you put the concepts together, it builds a strategy. So daily chart, intraday chart, bottoming tails that are a breakdown that failed, 2 of them. All of these concepts coming together communicate that prices are going to go, in this case, up. And you say, well, how much up? Well, we really don't care as far as credit spreads goes, because we just don't want it to go down. And the pattern suggests that. Now, there's directional strategies that could be done to make money directionally, but we're not talking about that today.
Right. Yeah, Jason, I don't know if he's being sarcastic or whatever. He's saying, "Oh, you only made 4% return." Well, I have two comments, Jason. Number one, uh, who makes back to what I said in the intro? What if I said in a marketing piece, "Hey, come, I'm going to show you a strategy where you can make 4% return on your capital in hours." I would hit the delete button. I'm like, these guys are full of you know what. But number two, which I just typed, why don't you divide, let's just say you have a $5 target as a swing. Divide $5 by $800 and you know, you got nothing. So you got to take with a grain of salt your, you know, your returns. We're focused more on, hey, this is good premium for the setup and where our stop is going to be. So this one extended, that's a power move. There's no way I would short that as a swing trade. But then look, but this particular day, we noticed a big, ugly, wide range bar that went deep into this. And then we said, okay, I don't think it's going to take out the day's high for a couple hours. That's the only bet we're taking in this strategy. We sold a $10 wide, 48 cents, like a melting ice cube. Look, the thing fell a little bit, but it's just bobbling around here in a trading range.
And it's not a directional strategy.
Right. In 2 hours, we booked half of that. So, right, this is a new strategy. It's a zero DTE strategy that we're teaching you. Of course, we have directional strategies.
Yeah. And let me just say, address something that typically comes up when we talk about, anybody talks about credit spreads, because ultimately someone out there is going to have a bad experience with credit spreads because the risk versus the reward, while it doesn't make sense, but it does make sense when you apply this chart analysis that we're explaining. And someone earlier said, well, do you use Greeks? I don't know Greek. I don't care about Greeks. Dan looks at certain Thea, Delta, what have you. I don't know as far as credit spreads, but for me, I look at the chart, I look at the premium, does it make sense or not? I don't know about Greeks. But those that don't look at charts, they probably would never even do this based on Greeks. But if they did, you're much more likely to get run over. So remember, this is starting with the chart, and the technical analysis part puts the odds in your favor tremendously. Then you go and see, is there premium there? Then you say, will this happen? What is this likely to go in this direction to this level in the next several hours?
That's simple.
You make a decision.
And we don't do them every day. Like today, for example, folks, Wednesday, it's expiration day on spiders. We're going to get to those examples in a few moments. We did not do a zero DTE trade today because our bias on the daily is a big mess. And we have FOMC at 2 o'clock and it didn't pass our checklist. Greg, why don't you explain reversal periods, and you know, when our patterns line up with these, it's a good thing too.
Yeah, you know, so reversal periods are something that I come across almost 30 years ago, maybe close to that, and I would just print out a 5-minute chart of the S&P every day, practice patterns, learning, what have you, and said, hey, look, the same thing happens almost every day around these periods. And they still work today, primarily in the morning, 10 o'clock, 10:30, later in the day. For whatever reason, you know, people are more aggressive, time goes on, who knows, doesn't matter. Just something that, you know, we follow. So you stay alert during those times. If you need to, you can set a little alert at 10 o'clock or 10:30. It's like, hey, pay attention. If things have been going one direction for an hour, they're likely to reverse or stall. And from there, as I said, this is one concept. From there, where are prices in relation to support or resistance in the trend in multiple timeframes, relative strength and weakness? And is this a reason to place a trade. So for example, if prices would gap up like they did today, and then they fell sharply for an hour into filling the gap and formed a reversal at 10:30, I would be looking to counter trend trade.
Great example.
So everything is simple once you first know, combine concepts, and practice.
Yep. Just a couple more examples, and then I want to focus on the spiders. So this is a very bullish gap on Amazon. But once again, we aren't touching this beast until we see if it sets up intraday. So this is pre-market again. It's sold off into the open because there's a vertical line. And right where it started breaking down right there. So let's say the stock was at 2030 then. We went $60 higher. So $10 over pre-market high. Did a $20 wide, took in $1.50 a share. I didn't do a 10 lot, but that's just my default. If I had sold a 10 lot, that would be $1,500 hits your account. It's yours to keep as long as this closes under 2090. This is one of our amazing traders in the green trading room, Dr. Paul Inkelis. We passionately call him McGraw, McGraw. This is him in his trading environment. And he is a very active trader, directional. He likes buying stocks options, selling options, but he really loves the SPX trades. And I'll show you another chart of his in a few moments. So Greg, the reason I'm showing this is a mess. This is an hourly chart and it's a mess. But why don't you point out with this concept of, of danger zones and where and why these still provide great 0 DTE credit spreads. All we're looking for is the turn.
Yeah, it's kind of a nice chart, Dan.
Yeah, you made it.
Oh. Yeah, so, danger zone was a way that I started explaining these credit spreads on SPX and, what we look at, because credit spreads have danger, like any trade does, but if you don't manage them properly, more so than other instruments. So when we look at how to put on a credit spread, we look at prior support and resistance, and are there multiple areas of support or resistance? So once they get past those reference points, you're getting close to the danger. So you have to have objective reference points based on the chart as to where you're wrong. That's what a stop loss is based on. Where am I wrong? Where am I maybe partially wrong? Remember, the attraction of credit spreads is that it just doesn't have to close at that number. But the closer it gets to that number, the greater the danger of a full loss, which we never want to experience. So we have to define these levels. And looking at the chart here, that's been marked up. They provide us clear, objective reference points.
Yep. So yeah, and here's just another example. This is a 15-minute chart, but this is what we're looking for, folks. I'm not giving you any of the math on this chart. I'm just focusing on the patterns. And everywhere I have an arrow here, we would be paying attention to the spiders or SPX, the big contract, and then going through our checklist to see if we wanted to put on a put spread here, right here. This is a no-brainer, a small little M top. This is what we call a sell setup. So for example, right here, we'd be selling an out of the money bear call credit spread. On this day, this is a beautiful, what we call W bottom. We'd be selling an out of the money put spread. Could this have gone up and immediately tanked? Of course, folks, we have 85% average. You didn't hear me say we have 100%. So we would take a stop loss. And depending on where it was, so right at this green bar, little, one there, we go through our checklist, sell a put spread.
So Dan, let me just point out here
Please.
for things. So let's assume I'm drawing these lines here on the right side. We were thinking about putting on a put spread because it gapped up and then formed this reversal right here. So as it starts to go up, we'd say, well, where are our danger zones? Well, if it breaks the low of the day, that's not going to be a good thing. Well, what if our spread is down here at 274, our initial strike, right? That we're going to sell. Well, we've got this line of protection. If it gets through it, that's a problem. And then we've got this gap fill type of area, this support area here as a line of protection. And then lastly, obviously, we're into a real problem at 274 if it should really get down there. Now, as we look at the option table, we look at how far away from the danger we could be. So if by chance, and more so this with SPX, we really would find that premium really far away. Let's say our strike was down here at 272. Well, now I've got 3 areas of protection before it gets down there. If it starts going down there during the trading day, am I nervous? Oh yeah. Oh yes, because this thing has some big leverage to it, and I've been there. And at the end of the day, I've gotten a little smacked a couple of times. It wasn't pleasant, but I've had days where it gets close, but they say like no cigar, right? It gets, and then because this is where buyers are going to be. So as it comes down there, it bounces back up. Every time it bounces back up, the time decay pulls a little bit more out of that thing.
Right.
And that's the advantage of the time that's just eroding this instrument.
Yep. Awesome. All right. So here was one. We had a bearish gap down in the spiders. Again, that's why we start with the daily. Now I'm looking for my intraday setup. These vertical lines are pre-market. It rallied into the open of the day and then got slammed back down. I have tails. Right here where these arrows are was our no-brainer entry to sell an out-of-the-money bear call credit spread. Our stop is the high of the day. We manage in between. That's it. It's another trade. All right, so now I want to get to the fallacies of these. Let's take them one by one. Selling short-term expiring options is incredibly risky. I don't even know how to answer that one. Why? Why is it everything in trading is reward to risk? We just showed you how we start with a high probability setup. I'll get to the checklist in a moment. We put it on, we have a stop loss, and we manage in between. Some say, again, don't ever sell short-term options because of gamma risk. What gamma means in the Greek world, it's just measuring the speed of the underlying, the speed of the delta, another Greek, which we don't even care about. The reason we don't care about it is because the folks that say, oh my gosh, the gamma risk, they are not chart readers. So yes, gamma risk is a big concern to people who don't read charts. For us, I don't care what gamma is. We are managing off the setup that we entered. And like I said, our stop loss, and then we're trailing pivots. The reward to risk is poor because the defined max loss dwarfs the credit received. That's what one of you asked earlier, and I addressed that on Tesla, I think it was, when I said, hey, we took in $1.85 a share, but our defined max loss was $18.15, the spread with less credit received. And that's just ridiculous. When people also ask me that, oh, you're selling a credit spread on whatever. So here, let's take Apple, for example. It's $115 now after it's split. and let's say I have a $3 target, long or short, I don't even care. Do you say to yourself, well, Apple can go to 0, so I'm risking $115 to make 3. That reward to risk doesn't make sense. Nobody ever says that. They look at their stop loss and say, okay, I'm risking this to make this. Well, why is this different than when we talk about credit spreads? We have a stop loss in place. I think people, Greg, they just hear something from whomever and they just keep regurgitating it like fake news, but it's unless something gaps against you for you to hit your max loss, and then that would be bad. It doesn't exist in 0 DTE trading because we're only holding these for hours. I heard some clown say, oh, as soon as you sell an option, that money is immediate profit. It's not. As soon as you open it, as soon as it goes in your account, you're actually down a few pennies because of the spread. You have 0 unrealized gain because you have obligations in return for that money that just hit your account. So don't ever believe anyone who says that. Some other people say, don't ever sell options in low volatility environments. And then they also say when volatility is high, sell both calls and puts. That's preposterous without a chart bias. I get this one sometimes. They're like, hey, what are you all talking about? Who is gonna sell us these options, Greg? So where's this money coming from? What idiot is selling you these options? Well, the answer is market makers. Market makers using their Black-Scholes model or whatever other model they're using for option evaluation, pull up any option you want. Right now it's 12:40 Eastern time. Pull up the spiders, pull up Apple, pull up anything, and you will see beautiful quotes there through the end of the day. And that's what we are trading. And some people say, well, you're only going to make money if it moves against the short strike. We make money if the stock moves in the intended direction. We make money in time decay, and we make money in volatility contraction. And that's why the stock can go against us a little bit and we still make money. So all of those are just incorrect myths in the market. Just another example here. I want to keep going so we can spend some time. But this, Greg and I would call this just another no-brainer setup. This was a bearish close, gapped up, deep to resistance, took out the 30-minute high. We sold this put spread here, 52 cents. So see, I say close. So you asked me, what do we do in between? I'm taking partial profits. So you can see here later in the day, we closed half at 14 cents. And I said, bid 2 cents for the back half and be done with it. We like to get out of these just so we don't have any gap risk, which I'll get to in a moment. This is what a subscriber emailed me the other day. And we hear this from our subscribers. I made money and the stock went against me. That doesn't apply if you buy or sell stocks. It does when you sell options because of the time decay component. So look, I still made money. This is an absurd strategy. Sarcastic tone. These are all his words. I just chopped them up and put them in these bullets. So, you know, he's enjoying this strategy. Another example, you know, we can go on and on. This is McGraw, who I showed you his trading station. He loves the big contract, SPX. And I'm not showing you this to suggest that you're going to have this same staggering 97%, but these are his real numbers. I mean, he's been in the business for a long time. 90s and the 80s, but I love this statement of his. This old dog has learned some new tricks because being with us and learning our technical approach, he sent me this, 89 for 92 profitable trades. Amazing. And I'm just showing you this on the VIX because it's another tool. This is a volatility ETF. So when we see a setup in the spiders that we want to sell a put spread or a call spread for the day, I always come look at VIX to see if we can do a companion credit spread trade or naked. I have a whole separate seminar, 4-hour seminar on trading volatility. Let me address this real quick. Exercise risk and request deadlines. So at 4 p.m., the Options Clearing Corp, they will assign options if they expire 1 cent in the money. They're just doing what the option trader asked them to do. They're doing their job. So you will get a margin call if you get assigned and don't have the buying power in your account. And then I put in parentheses here, and possible forced closure of a position. Let's say Amazon here is trading at 31.70, over $3,000. If you have a $10 wide on that, which only requires $10,000 of buying power, and it's moving around and getting close to the short strike, don't be surprised if your broker closes you out of that, because they don't want this assignment risk either. So the reason we like to close these out is for post-market risk. So right here, this fourth bullet, the only 100% way not to get assigned is to close it out, because the option holder, if there's a big market move, can pick up the telephone, call the broker and say, assign that. And this is a big plus here, this last note for SPX options. They are cash settled, and they're based on the 4 p.m. Eastern settlement price. So you don't have that residual risk of the spiders moving around. All right, let's take a look at this real quick, and then we'll scan together to see if we can find some of these. So here's my checklist for this approach. Scan your universe, gaps, news, earnings, high volatilities. Make sure they're liquid, of course. Spiders is a favorite. It's really just doing everything that we just showed you here. If it's a bullish setup, sell out of the money put spreads, under support, stop the low. This is key. Make sure the options are liquid, folks. Liquid, liquid, liquid. And I call it juice, which is the premium. And I teach all that in my course, what liquid is, what juice is, and all of this. But you got to make sure that the premium that's going to hit your account is worth the perceived risk that you're putting on. And obviously every example in this presentation today is. Follow your trading plan, close into expiration if you want 0 assignment risk. That's it. So here's Greg's amazing swing trading course, where he talks about all the concepts that make up the method to objectively analyze anything that moves, anything that can be charted. This course will help you understand what's going on there, supply and demand patterns. Here is the credit spread courses. Advanced, we have 5 module course on selling credit spreads. And these don't just specifically refer to 0 DTE. This Mastering Advanced Credit Spread course is a more detailed 12 module course. And one of the whole course helps you with this strategy, of course. But one of the 12 modules is solely dedicated to that strategy. And then we have a little platinum package here that throws in 3 months of our live trading room and 3 months of our weekly options trader, which is where you get these 0 DTE trades. And as Greg is switching the screen, I just pulled some of these prior testimonials out about our Mastering Credit Spread course. It's great. I put our strategies up to anybody out there. We have a lot of happy subscribers. So now Greg will pull up his screen and we'll do a little bit of scanning. If you all have any questions about any zero DTE candidate today, we'll show you how we walk through our checklist to tell you if we like it or not. So it's going to be the pattern, and then we pull up the option quote, see if they're liquid, what the juice is, where the stop is. And with one caveat, even if I say I like something, the only caveat is we have FOMC minutes. But we'll show you our approach.
All right. Screen up here. So this particular scan looks for stocks moving sideways, which is a good place to look for credit spreads.
But Elton is asking about Netflix. Elton, yes, I already sent Netflix to our subscribers saying that it's a good credit spread candidate. Now, today obviously is only Wednesday, so we don't have the Friday expiration. The only one that is expiring today is SPY and SPX. But for a 2-day credit spread, yeah, Netflix looks great. Provided, I would have to go and look at the strike and see what the credit is.
So obviously this would be a good one under $500. So you'd have to go to the end of the week. So we have a pattern. That's the process. We have a pattern. Why? Red bar ignored, red bar ignored. It held above this area. We say, okay, $500. It should never go below $500 based on this pattern.
We'll even do 505. Right. 505 is fine too.
Yeah. So we can get closer, but we look for the no-brainer first. So $500, right? 55 cents by 61 cents. Now you could go whatever, 20 apart. Almost, I shouldn't say it doesn't matter, but look, I look at something like this and say, unless this comes out with some terrible news tomorrow, of course, which is possible, it's not going under $500.
Agreed. Looks fantastic.
Okay, so if I take that wider spread, more risk, I think it's worth it to get that premium for $500. If you go to 505, not that much more.
Right.
And as you get closer to the danger zone, you get more money, risk to reward. So if I said, well, and of course it's almost 1 o'clock, there's still, several hours till the end of the day. I don't even think this will ever even go under the low of today, which is 515. So let me go 510 and give it a little extra room. Now I'm getting $1. Is it worth it? Some of this becomes personal to you, the risk you're willing to take to gain the reward. Is it more possible that it could go under today's low, then go under 500? Of course. Are you willing to do it? It's your choice. That's what it comes down to. And as you go further and further away, let's say, oh, well, if I said, oh, what am I willing to do something at 490? 490. Well, now you're only getting 30 cents by whatever. It starts to come to the point where it's just not worth it.
Right, unless, we're trying to focus on zero DTE, but then we would have to ask ourselves, is it worth going out another week to get the bigger credit?
Right.
And that's what my course and the weekly options trader, our weekly options trader sells options that expire 10 days or less. So depending on what the broader market bias is, we might consider it for 9 DTE.
So yeah, for 9 days,
okay.
you're going to say something's wrong. I can get $2.
That's totally normal. Nothing's wrong at all. No,
pretty far away.
Right, but when you do a spread, it's going to reduce that by a lot.
Of course, it's going to report earnings on the 20th.
Yeah, no, it's not earnings, but no, those are normal premiums. Sure.
Okay. So point me, the closer you get to earnings, the more potential for wild moves. And so as you look at this option table, you might see something that looks like, wow, they're just giving money away. Well, you better look and see when the earnings are coming out.
Right.
Some news.
Well, or any other news, like, you know, Tesla, Apple, they might have a conference going on or something, an announcement. Yeah, like Tesla's battery day. Remember that?
Right.
All right, so they're asking about in Twitter. Lionel asked about Twitter call spread, and I'm looking at it. Very possible for Friday. But yeah, Intel's fine. Look at
Right. So look, you look at the pattern. This hasn't broken out. You look at where support is. You go to the option table. All right, and there's no premium for 3 days. Then of course you can look further out. That's the process. What was the other one, Dan?
Twitter call spread for Friday over yesterday's fine.
I wouldn't do it.
Right. I would do a 0 DTE though, Lionel, without a doubt.
Yeah.
If there was premium, without a doubt, because I have no gap risk.
Yeah. You wouldn't think that could go over yesterday's high, but you know, it's in an uptrend and it's strong. Could be a red bar ignored. I look further out, see if there's any resistance, and it is right up at an area of major resistance. This could be the top of it, just based on that. So this scan, Apple popped to the top. It's looking for things that are going sideways. And sometimes you find things that look like good breakouts, but you know, Apple's just going sideways here. So it puts you in the ballpark. Then you just look, you know, how compelling is this pattern? I'm really not sure which way it can go in either direction. So I don't love it.
Well, Greg, actually show them Facebook. We gave them a call spread this morning.
Yeah. And what were the strikes? I would imagine above here.
Right.
Or above yesterday, either yesterday's high or above the pivot.
It was actually the pivot.
Yeah, 270.
Yeah.
Calls. Go to the green one. And I don't know what it was. Had to be higher than that this morning.
Yeah, no, and we actually did it for next week, but yeah, we got a good fill.
Okay, that definitely looks lower. And the weekly looks like if it closes like this, it's going to go quite a bit lower.
I agree.
Yeah. And so, and just looking at the patterns, right, these are usually going to be sloppy bases. That's exactly what we're looking for, sloppy bases. And then where might it not go, right? Probably wouldn't go above $40. And no premium for 3 days, 9 days. Not bad, but the earnings are on the 14th. So that the next step is there's premium, when are earnings? Today is what, the 7th, a week away. You got to go out 9 days. So you're right into the earnings. This is going to report tomorrow. No, you don't want to go there. There's Facebook. There's Intel. You can see they're coming up in the scan here. The scan puts you in the ballpark. By the way, when you sign up for the course, you get the scans. Microsoft, we got a pivot high up there. That's kind of a little baby bearish island reversal, gap up, gap down. 214 calls, 215, no premium at 215. And you want to go out further, $1.27, when's earnings? Far enough away, but work. Right?
Yeah, nice move.
Yeah, very nice.
Yeah.
So it's breaking out, and you look down below for the end of the week. This is TC 2000, Rodney. So we use it for scanning, and I've created these scans. What software package it used? Yeah, I answered. Frenchie, DTE, days to expiration. 1 second. I usually post for you guys say in the green room to YouTube, but this was from YouTube. And go through the scans. So Delta earnings next week. No. Cisco earnings next month. That's okay. But I'm thinking this thing has no premium one way or the other. And it's not, it's relatively tight. We're looking for bigger bars that strongly suggest it's not going to go in one direction or the other, like this, especially if it retested and reverses. But you know, it's in a downtrend, but under 14 bucks, there aren't going to be any premium there. It's just typically not the case, especially with a few days. Of course not. Dan, you know how high this stock was at one time?
No.
It's unbelievable. Look at this. It was almost $120 stock.
Wow.
Right.
Amazing.
Long term. So you guys get the idea, you know, airlines, just a total mess. But again, the scan is looking for messy sideways bases. This one is looking for stocks that are likely to move up, moving up or continue to move up. This one going down. And you go through the pattern. That's the factory work. And again, why we got wide range bar scans, 1, 2, 3s, pullbacks, bottoming tails, 180 reversals, different time frames. This is an amazing piece of software. And I wish I owned it. I don't have an affiliation with them, you know, so they don't pay us for promoting it, but you cannot deny something that is superior. But the scans combined, it's just like, here's a cannon. Well, if you don't have any cannonballs, what good is it? So the scans analogy is kind of like putting the cannonballs in the cannon. It puts you in the ballpark of what we're looking for with different concepts. Here we're talking about credit spreads. We look for swing trades, up and down, reversals. So I love this software. I've been using it for a huge amount of time, many, many years. And I can't say enough positive things about it, but you know, what we've covered here today will get you started with credit spreads and, you know, take Dan's course, consider the swing course, and, you know, you start doing this and you can start doing the factory work, which is a pleasure because in the end, we're looking for what can put money in our pockets. And that's the whole goal here, right? Yeah, you have to have TC 2000. It's relatively inexpensive, but, you know, go to their site, you know, warrenbrothers.com or tc2000.com, one or the other. And, you know, you can check it out. Right? I don't know of any other alternative, Robert. I don't know why you can't get TC 2000. I think anybody can. You can't trade on it. We don't trade on it. We just use it for scans. So I think I don't see why a Canadian can't use TC 2000 for scans. So.
All right, very
All
good.
the best, everybody. We'll be back next Wednesday. And any questions, email Dan and I, Dan at Master Trader, Dan at Master Trader. We'll talk to you next week. Back to the green room.
Good trading, everyone.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.